Morning, my name is Bianca Haywood and I will be taking you through Spar's results presentation. Please note that I will not be answering questions throughout the session. However, you're more than welcome to ask questions. Please type them into the chat box and I will be getting back to you via email correspondence. Let's take a look at what we will be covering today. I'm going to start off with the nature of business, followed by the recommendation, the financial review, divisional review, company guidance, and conclude with the portfolio guidance. Now taking a look at the nature of business. Spar is a warehousing and distribution business listed on the JSE in the food and drug retailer sector. The group is headquartered in Durban, South Africa, and has been operating in Southern Africa for over 5 decades. With the acquisition of Spar Switzerland in 2016, the group expanded its business portfolio into a major third geography, which is complementary to the group's operations in Ireland and Southwest England. Now moving over to the recommendation. We feel that the share is fairly valued, trading at a forward PE multiple of 17.7 times, and would recommend longer-term investors to hold the share. Ireland and Switzerland's results are encouraging, but the sustainability of the operational turnaround is still uncertain. Additional increased competition has resulted in recent earnings softness in Southern African operations, with the group's market share under threat. The group is trading in line with its long-term PE average, which might be slightly rich, given the higher than historic forecasting risk. This might be supported by operating margins that seems below average. However, we feel that a recovery in margins is only a longer-term story. Now moving on to the financial review. Spar delivered a subdued set of results for the year ending September 2017, impacted by the challenging trading environment in South Africa. Competition continued to intensify amongst retailers. Despite these challenges, the group's Irish business delivered encouraging results, and the Swiss business showed the first signs of a recovery. Turnover increased by 5% to 95.5 billion, with turnover from outside of South Africa accounting for 32% of total turnover. Gross profit rose 15% to 9.6 billion, resulting in a higher gross margin of 10.1%, up from 9.3% in the previous year, driven by the higher margin offshore business. Adjusted operating profit declined by 1% to 2.6 billion, resulting in the adjusted operating margin contracting 20 basis points to 2.7%. Ultimately, headline earnings came in relatively unchanged at 1.8 billion, limited by a slightly higher effective tax rate. On a normalized basis, after adjusting for fair value adjustments and foreign exchange rate adjustments to financial liabilities, headline earnings actually increased by 1.2%. Headline earnings on a per-share basis declined by 7% to 952.5 cents per share, diluted by a 7% increase in the weighted average number of shares in issues to fund the Swiss and Irish acquisitions. The full-year dividend increased by 1.5% to 675 cents per share. Now moving over to the divisions. Starting off with Southern Africa, this is the group's largest division and contributed 68% to group turnover and 78% to operating profit. Turnover increased 4.5% to 64.5 billion. Internal inflation averaged 6% for the year, much lower than in the first half of the year due to declining commodity prices in the second half of the year. Combined food and liquor sales increased by 4.9%. Gross margin declined 7 basis points to 8.2% as the group continued to invest in lower prices. Operating profit contracted 2.5% to 2 billion, with the operating profit down 4.7% in the first half of the year and only down 0.2% in the second half of the year. Profits were impacted by tough trading conditions, which increased the costs associated with the stores acquired. The operating margin declined slightly to 3.1%, down from 3.3% in the previous year. Capital expenditure amounted to 516 million. Taking a look at Spar stores. Spar stores contributed 80% to Southern African turnover and was impacted by constrained consumer spending, with retail turnover growth of 4.5%, while on a like-for-like basis it was up 4.2%. Retail trading space increased by 1.7%. During the year, 149 stores were revamped and a net new 13 stores were opened, bringing the store count to 903 Spar stores. Spar's wholesale turnover increased by 4.2%, with the demand for Spar branded products up 9.7%. Spar's total house brand sales increased to 10 billion. Now taking a look at Tops at Spar. Tops at Spar contributed 9% to Southern African turnover and reported retail turnover growth of 12.4% and 9.7% on a like-for-like basis. Wholesale turnover increased by 11.2%. During the year, 51 new Tops stores were added, bringing the total number of Tops stores to 733 stores. Retail liquor trading space increased by 5.8%. The bulk of the stores has been converted to the new Spars at Tops logo, and 50 stores were revamped. Build It contributed 11% to Southern African turnover and increased retail turnover by 4.3%. However, on a like-for-like basis, retail turnover was only up 1.1%. Wholesale turnover increased by 2.1%. Cement inflation averaged 2% with a strong recovery in the second half. Demand for Build It house brands was robust, with sales up 18.7% to 338.6 million. Taking a look at distributions, volumes handled declined by 2.6%, with 224.5 million cases dispatched. During the year, the group invested 134.1 million in the expansion of the Western Cape and North Rand perishables facilities. Now moving over to Ireland. The region contributed 21% to group turnover and 20% to operating profit. Turnover declined by 11% to 20.5 billion, impacted by the euro weakening against the rand, which eroded the strong performance from Ireland. On a constant currency basis, however, turnover was up 1.5%. Spar and XL brands reported strong sales growth. The Londis business was successfully integrated into the BWG supply chain and achieved sales growth of 4.6%. Wine and spirits business recorded robust growth of 17.8%, while the food services delivered sales that increased by 13.2%. The grocery market remained in a deflationary cycle, with food and non-alcoholic beverages recording a 2% deflation. Cases dispatched increased by 8.5% to 35.1 million. Gillette's and higher perishable volumes contributed to the higher gross margin of 12.1%, up from 10.8% in the previous year. Operating profit rose 4% to 508.2 million, resulting in an improved operating margin of 2.5%, up from 2.1%. The euro-denominated margin improved to 11.2%. During the year, 73 new stores were added, bringing the total number of stores to 1,330. Capital expenditure amounted to 354.1 million due to investments in retail and technology upgrades. Now taking a look at Switzerland. The region contributed 11% to group turnover and 3% to operating profit. It is important to note that this was the first full year of consolidation compared to only 6 months in the prior year. New management team started yielding results and returned Spar Switzerland to profitability. Turnover was up 77% or 94.7% on a constant currency basis. Inflation increased by 0.3% year on year. Gross margin improved to 18%, up from 14%, which management considers sustainable. Operating profit rose 53% to 69 million after adjusting for a pension charge of 26.2 million. The operating margin contracted 10 basis points to 0.7%. CapEx amounted to 220.8 million due to investments in retail and technology upgrades. Now moving over to the company guidance. The group expects political and economic uncertainty to persist in Southern Africa. However, the group will continue to invest in its distribution network, competitive pricing, and product ranges. The group has invested in its digital platform to get more feet into the stores. The Spar Rewards added several new members, and Spar Money Transfer was launched in South Africa. The uptake of house brands in Southern Africa continued, with 235 Spar branded single stock keeping units added in 2017. The group remains cautious about Ireland's outlook and will continue to look for expansion opportunities to expand its offering and strengthen its retail network. Spar Island's Better Choices campaign was launched, which focused on healthy eating. Spar Switzerland has shown early signs of a turnaround, and the group will continue to focus on improving the region's performance. Spar Switzerland's advertising program is focused on convenience-driven pricing. The group has made progress with its investment in Sri Lanka and plans to open its first store in 2018. After reporting that the group acquired a 60% stake in the pharmaceutical wholesaler Spar for a total purchase consideration of 45 million, with an additional contingent consideration of 29.9 million, calculated based on a multiple of profit after tax. The group will acquire the remaining 40% shareholding between September 2022 and December 2022 based on the value of the remaining shareholders' loans and profit after tax. The group will leverage the pharmacy at Spar offering through the S-Base acquisition. Now moving over to the portfolio guidance. The group is a good quality company with a solid track record, consistently high return on equity, and historically good cash generation. Spar has a weighting of 0.6% in the capped SWIX, and we remain neutral on the investment and would recommend portfolio exposure of up to 2.22%. Just before I conclude my webinar, please take note of the following disclaimer. Should you wish to place a trade, please contact our trading desk. Should you wish to ask questions, please type them into the chat box. Thank you and enjoy the rest of your day.